Welcome to the Valuation Institute. Learn from the industry experts.
Hey everyone, and welcome. You ever look at a huge company and just wonder, what is that thing actually worth? It seems like a simple question, right? But it's probably one of the most important questions in the entire world of finance. Today, we're going to peel back the layers on valuation and get into the three main ways the pros figure this stuff out. Seriously, this one question, it sits at the very heart of investing, of business strategy, of, well, pretty much everything. It's the number that drives epic IPOs, huge mergers, and even the choices you might make for your own investments. The question itself sounds easy, but as you're about to see, getting to the answer, that's where the real magic happens.
Okay, to get our heads around this, let's use a simple analogy. Imagine you're buying a rental property. You wouldn't just blindly pay whatever the seller is asking. No way. Your brain is immediately focused on one thing. How much rent, how much cash is this place going to make for me down the road? A business at its core is no different. Its value today is all about the benefits it's going to provide in the future.
So if we want to get technical, valuation is just the process of figuring out that economic worth. But here's the absolute key idea, the thing you have to remember. It's all about calculating the present value of future benefits. And you know what those future benefits usually are? Yep, cold, hard cash. So here's our game plan. First, we're going to look at the future cash method. Then, we'll jump to the comparison method. After that, we'll check out the building blocks method. And finally, we'll talk about how this is really both an art and a science. Let's do it.
First up, we've got the income approach, which you'll almost always hear called the discounted cash flow or just DCF method. You can kind of think of this as the fortune teller's approach. We're literally trying to peer into the future to figure out what something is worth today.
Now, the whole engine that makes this method run is something called the time value of money. All it means is that $1 in your pocket right now is worth more than the promise of $1 a year from now. Why? Well, it's pretty simple, right? You could take that dollar today and invest it and it would grow. DCF is just the fancy math that accounts for that basic fundamental truth.
So, how do we actually do this? Well, it breaks down into 4 key steps. First, you have to forecast all the cash you think the company will make, usually for the next 5 or 10 years. This is like guessing all the future rent checks from our rental property. Second, you discount all that future cash back to today's value. That's the time value of money part. Third, and this is a big one, since a good company could run forever, you have to estimate its value for all the years beyond your forecast. We call that the terminal value. And finally, you just add it all up. Boom, you've got your estimated value. So what's the upside? Well, it's that this method is grounded in the company's real, fundamental ability to make money. But here's the catch, and it's a huge one. It is completely at the mercy of your assumptions. If you change your guess for the growth rate by just a tiny little bit, you can get a totally different, wildly different final number. It's incredibly powerful, but also super delicate. Okay, so if trying to predict the future feels a little bit like gazing into a crystal ball, our second method is way more grounded in what's happening right now. This is the market approach. Forget fortune telling, this is more like looking at your neighbors. It's the exact same logic you'd use to price your house by seeing what similar houses on your street just sold for.
Yeah, this whole method really just boils down to one simple question. What are comparable companies selling for on the stock market right now? So instead of building a complicated model from the ground up, you just use the market's current opinion as your guide.
Let me show you a really quick example of how this works. Let's say other companies in the same industry are trading at 20 times their yearly earnings. That 20 times is what we call a multiple. In this case, the price to earnings, or PE, multiple. So if our company has earnings of, say, 100 crore, we just do the math. 100 crore times 20, and we get an estimated value of 2,000 crore. See? It's a much quicker path to getting an answer.
And PE is just one tool in the toolbox. Analysts use all sorts of these yardsticks to compare companies. They might look at a company's value compared to its core profit, or its sales, or the value of its assets. Each one gives you a slightly different angle on how the company stacks up against its competition.
All right, on to our third and final method, the asset-based approach. This is, by far, the most tangible one. So for a minute, let's forget about future predictions and market gossip. This one is all about one thing, taking inventory of all the stuff the company owns right now.
I mean, look at this formula. It really couldn't be any simpler. You just add up the value of everything the company owns, that's its assets, and then you subtract everything it owes, that's its liabilities. And what you have left over is the company's net asset value. It's basically the company's net worth on paper. So when does this come in handy? Well, it's great for businesses that own a lot of physical stuff, like real estate firms or big holding companies. It's also really useful for looking at struggling companies that might have to sell everything off. But, and this is a big but, it has one massive blind spot. It tells you nothing about the future. Intangible things like a powerful brand, a genius team, or incredible growth potential, they're totally invisible with this method. It's a look in the rearview mirror, not at the road ahead.
So, we've got 3 totally different ways of looking at a company. One looks at the future, one looks at the present, and one looks at the past. So, which one is right? Well, the real answer is you kind of need all of them. This is where the whole thing becomes less of a science and more of an art.
Let's just sum it up real quick. The income approach is all about the future, asking, what's this thing going to earn? The market approach is about the present, asking, what are similar things worth right now? And the asset-based approach looks at the past, asking, what are all its individual pieces worth? Each one gives you a critical piece of the valuation puzzle.
And that brings us to this classic saying, because it's absolutely true. Valuation is both an art and a science. The science part, that's the spreadsheets, the formulas, the models. But the art, that's in all the assumptions you have to make. What growth rate do you pick? Which companies are really good comparisons? That's where human judgment, experience, and skill are absolutely essential.
And because of that, no professional analyst, and I mean nobody, relies on just one of these methods. They use them all to triangulate, to zero in on an answer. The goal is not to find one single magical perfect number. The real goal is to come up with a defensible range of what that company is probably worth. So, I'll leave you with this to think about. If finding a company's worth requires you to blend its future, its present, and its past, what does that really tell us about the idea of a single true value? Maybe the point isn't to find that one perfect number, but to really understand the whole story the numbers are telling us. Thanks so much for joining me for this explainer.
Thanks for watching. Subscribe, like and comment.